You don't want to buy, it takes like 30 months to own to
Over
fill,
leverage self, yeah.
yeah, to fill self-storage. It's
Mm,
huge. So
mm,
it's like you're trying to leverage your minimum debt so that you're making the
mm,
maximum
mm,
profit. So
mm.
Welcome to Unstoppable Podcast with Harry Sardinas, inspiring conversations with influential millionaires, investors, thought leaders, entrepreneurs who are making a massive difference with their innovative products and services, and sharing the challenges and wisdom of how they sold their first million.
So, what is your view in regulation? Can we do about it? And do you think that is people are taking the decisions? They should be maybe they should spend more time with entrepreneurs to see what actually we do. Then,
I, I mean, the market change that we've seen for Airbnb is
mm,
more of a change to middle term rentals. So it's no longer this kind of, we've got whole provinces inside Canada that are just said Airbnb, no more. Like you have to live in the residence to rent out like your basement or rent out a room. You cannot be outside the house. So that killed a lot of Airbnbs. So in other areas, it's gone to a middle term where, it's like maybe you're renting it out, but it's for 3 to 6 months. And you're saying, I'm going to rent it out to, flight attendants or nurses or, corporate people who are visiting downtown sectors. And you're renting it to bigger corporations and you're saying, I will allot this for you guys and I'll give it fully furnished and you guys just relax there and you can always rely on that. And they might do that during, the off season and they might do some Airbnb, but they're starting to become more flexible. Like they can't do 100% Airbnb.
yep.
It's not reliable. It's seen it too many times where these guys have actually they've
Mm.
had too many compromises maybe on their property and Airbnb has decided to go with the tenant or the client and said, no, we are going to side with the tenant. You are responsible for these bad ratings or, for
Mm.
insufficient support for doing your rental. And so basically they start docking them stars and bad ratings and they even pull the listing, basically killing the whole property.
Mm.
So it's just too much risk. I can't have any one organization be in such control.
Mm.
So that's
To
only,
the yeah, and you're a math
yeah,
guy, so you like your numbers, okay, and you like that the numbers
yeah,
work best.
yeah,
And I like Nigel, your step number one, do the math because that
yes,
reflects that you are a person that will take time doing due diligence. And people think that due diligence is
right.
just go to the
It's,
site and so on, but it's
yeah,
actually do the math for real
yes.
and mitigate your risk. And I guess this is the part that you love. So tell
Do,
us, go ahead.
yeah. I mean, doing the math is more of a, if you don't understand the deal, like it may take me longer on the first time to actually understand the deal if it's something different. But the thing is that I can explain it to myself and I can understand what the strengths and weaknesses are of the deal. It's kind of like I meet too many younger entrepreneurs or, who are kind of going to real estate and they're like, whatever, it's going to make $200 a month. That's good. And I'm like, is that the best, outcome that you're going for? Like, I mean, a
Hmm.
small hiccup that month, you're negative. And it's like
Absolutely.
maybe you should be teaming with someone else and
I'm
maybe
glad you
putting a
brought
little
this
bit
up
more down.
because
It's like
we were
it's a
talking about
lot of risk. Risk is basically mitigated by doing better math. So I mean whether that's, looking and doing your research better and not making grand assumptions like, oh, this will always go up, it'll always increase in value. And in Canada right
Mhm.
now, we're having a drop in rents across Canada,
Oh, wow.
which is
Hmm.
not a good thing. I mean, this is across the
Absolutely
board.
across
So I
the board.
mean,
Wow.
everybody's lost like 10, 15%. So now
Oh,
if
wow.
you buy a property and you're thinking, whatever, 100, 200 profit, you may now be eating 1,000, or $500. And that's some sectors of Canada, like Vancouver, which are in high demand, they're actually negative. and they're okay with it because their property is appreciating, even though the rent isn't covering it, but they're okay with it because they're willing to risk it all that one day the property will be like it'll can refinance the property and pay off the amount that they've been losing for years. And
Wow.
like it's such a dangerous game. But
Yes.
Toronto and
Sound
Vancouver
dangerous to
are in
me.
those. Yeah. So
Oh,
I mean,
wow.
I would rather go into like a secondary market, like
Mm-hmm.
outside the big city, where there is more flexibility, there is better rents and better, cash flow.
And the math work better, right?
I
Simple at
know.
the end of the day.
It's
I remember that when I
yeah,
de-escalate the property business, we managed to sell over
yeah,
5 million. But I remember that we used to this margin. We used to make. I remember like £2,000 per month cash flow, right?
yeah,
Profit after pay house. So
that
it
was
doesn't
good.
matter which deal you're gonna bring to. It doesn't matter if the deal is in US, the deal is in UK, the deal could be anywhere. But if it doesn't go close to these numbers, it doesn't work for me. It doesn't have my then and I don't care where the property
Yeah,
is. Could be in the North Pole. I'm this as
yes,
long as meet my numbers. I'm
exactly.
fine with it. But
Yeah,
and
if
that's
it,
the kind of flexibility
yeah,
now that you talk about when you are
yeah.
in this right. You go rigid, that can be a problem. Yeah, you people take too much risk, right?
Yeah, and it's more of an emotional thing where they're
Mm-hmm.
thinking, well, it'll be worth it. It's like I want that property, I like it, and it's just like, but it doesn't work in the math. And they're like, it doesn't matter,
Mm-hmm.
I like it, and it's just like you're overpaying. I don't
Mm-hmm.
care, and it's just like, no, that's an
Mm.
emotional. They assume that another property will not come
Okay.
along.
Okay. Next
So
question.
yeah,
Next, cash flow
oh
versus capital growth. I'm the type of guy, you see,
yeah,
that if I'm looking at the property, okay, and I can make my £2,000 a month profit, yeah. For me, if it goes on price or not is irrelevant. I'm not interested. Yeah, and actually, we property that they're actually like that. They haven't gone up, not even £1. Yeah, but
yeah,
consistently they generate cash flow around that range for so many years, right?
mm,
So, what's your opinion, cash flow versus whether other investor will say, no, 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 this house will go up in price, and this is when I'm gonna cash up. So I don't care if if I'm breaking even or if I make very little in rental. Um, so, what is your take on this and how you see? What's your favorite? Cash flow, capital growth, in the middle. I'm a cash flow 100%. That's Harry. Okay. It doesn't matter because we need money every month, right? We need money every day to buy the food, to go out, to put, I don't know, gas in the tank, whatever. Every month, if you don't have money that month, you right, or you cannot
right.
pay your bill. So, but in perspective, Nigel, as an investor, what is your formula and why?
I mean,
How
I
heavily
don't know.
will
I
you
mean,
be in will you be
I
in capital growth versus
No,
cash flow?
I'm a bit of both. That's just
Okay.
it. So I will
Balance.
take the cash flow.
60-40.
Yeah, I'll be a 60/40.
Very good.
So I want cash flow. Like, don't get me wrong. But then again, it's like if you've got a way like right now for a lot of commercial properties, you'll get like 1,000, 2,000 a month, which is
Mm-hmm.
ridiculous.
Mm-hmm.
Like that much money for the amount that you've got leveraged.
Mm-hmm.
So, but you can actually turn around and you can say, well, I'm going to do some forced depreciation where you're going to say, okay, I'm going to renovate a bunch
Mm-hmm.
of areas
Mm-hmm.
and so the cash flow will be impacted. But then if you're doing it towards your end of your, refinance period and you can refinance and get most of that money back and
Mm.
more, then I'll do that. So
Not
it's
too
kind of
bad.
like
Yeah.
I'll
Okay.
do the planned
Mm-hmm.
loss and
Mm-hmm.
then recuperate. But yes, I'm not buying into a losing property or tight margins
Mm-hmm.
for long term. No.
How about commercial versus residential? I heard that commercial is amazing. You don't have tenants. You don't have no one to call you 1 a.m. Hey, you need to feed my heater. Yeah. I used to
Uh,
have a lot of tenants, 177. Yeah.
yeah,
When you have 177 tenants and 28 property, something happen every single day. This we will
yeah.
never bore. Yeah. every day was something going on. If it's not washing machine, it's the window. So tell us, residential versus commercial. I hear people are telling me, like, I know a lot of
it,
property investors,
it,
that commercial is amazing.
yeah, commercial is final end goal. But yeah, the requirements to go commercial, like
Mm-hmm.
from your equity and your
Mm-hmm.
strength of your assets,
Mm-hmm.
because they're leaning on your assets.
Mm-hmm.
They're looking at the building and they're saying it'll
Mm-hmm.
cover. Now, great. Now, if something does go wrong, you can financially back this, and that's where most people fall down. But
Can we say
you know,
that is better, but the barrier to entry is higher?
I mean, it's less maintenance, but you're kind of in a good position because it's like, yeah, it's
Les
a bit of a
Martinez is
balance.
amazing. There are
Uh,
people that come to this podcast that they're buying warehouses, huge, all over United
yeah,
States, and they at the very good
right.
price and discounted price, and they're separating into
Yeah,
pieces and selling the units to invest to pieces, and then after they rent it, and you see there is no basically
yeah,
that's it. It's just storage space,
right.
and
I mean, if it's your location, I think, yeah, warehouses, like
they get it right.
self-storage.
Yeah.
Yeah,
Yes.
like self-storage, I want to get a self-storage in the next year. And I
Mm.
think that's the next thing too, because self-storage is so low maintenance. It's like you just put on Bluetooth
Sound
lock,
amazing. Yeah. And
yeah,
then you can
with
find a
Bluetooth
warehouse
camera.
discounted. Yeah.
Yeah, it's all on an app and you just kind of boom and it opens the lock. It's like you don't need someone there 24/7. It's like the cameras
Still,
record.
you have to buy the right price, and you have to
Yeah.
make sure that you have to know
But if
what you're doing, like everything. Yeah.
but I mean, if you
But it
can
sounds
get
less.
property,
Yes. Yes.
if you get a property that grows with you, kind of like self-storage, and you buy 1 acre and you fill it, then if you can expand to 2 acres, three, and you're
Mm-hmm.
working with the person who owns
Gradually.
3 acres,
Oh, there you go. You see, you're doing your
yeah,
math. Very
see,
good.
now you're working with the
Gradually.
math, so that's not working against you. You don't want
Mm.
to buy, it takes like 30 months to own to
Over
fill,
leverage yourself. Yeah.
yeah, to fill self-storage. It's
Mm.
huge. So
Mm.
it's like you're trying to leverage your minimum debt so that you're making the
Mm.
maximum
Mm.
profit. So
Mm.
Follow us for more interviews with world's most influential, audacious entrepreneurs that overcame challenges and adversity, providing you with the blueprint of how they sold their first million so you can grow your business exponentially.